Good morning, traders, and here's your market update for today. So, first, the US dollar index. Last week, the US dollar index staged a surprising comeback, shaking up global currency markets. The move was sparked by developments in the US monetary policy, particularly concerns surrounding the Federal Reserve's signal that the end of its quantitative tightening cycle might be approaching. This triggered a sharp sell off in US Treasuries and drove investors back to the dollar as a safe haven. Although the Fed did cut interest rates by 25 basis points, Chair Jerome Powell's cautious comments afterwards cooled expectations for further rate cuts in the near term. This gave the dollar some additional strength. From a broader perspective, whether the dollar's strong cycle has peaked depends on several key factors. First, how the real interest rate differentials evolve. Second, how liquidity improves across bond markets. And third, how major counterparty economies like the like the Eurozone, the UK, and Japan perform in response with their own monetary policies. At the moment, these factors remain mixed. That's why the dollar seems to be entering a more balanced, range-bound phase where it may face challenges breaking higher, but it also may have limited room for a sharp fall. So now turning to the oil markets. WTI continued to slide last week, briefly falling near the $59.70 per barrel mark. This is the third straight monthly decline as global supply pressures intensify ahead of the upcoming OPEC meeting. Production has been rising across several key regions. Saudi Arabia's exports have reached a 6-month high. US crude output hit a record 13.6 million barrels per day, and OPEC members are reportedly considering modest production increases to maintain market share. Together, these factors are all fueling fears of oversupply. On top of that, the stronger US dollar added extra weight to commodity prices. As a result, investor sentiment towards oil has turned increasingly bearish. From a technical standpoint, oil continues to follow a downward trend with resistance levels remaining firm above the $60 mark. Unless supply dynamics change significantly, this cautious tone is likely to persist in the short term. Now let's talk about gold, which has been on a roller coaster ride recently. So on Thursday, spot gold briefly climbed above the $4,000 per ounce mark, driven by safe haven demand and anticipation of more US rate cuts. But that rally quickly faded once Chair Jerome Powell's hawkish remarks dashed hopes of easier monetary policy. Gold prices fell back towards the $3,900 mark, erasing earlier gains and recording a weekly drop of over 3%. Still, it's worth remembering that gold has had an exceptional year, up more than 50% so far, and it recently reached all-time highs. At this stage, gold's direction depends heavily on whether the US maintains its tight policy stance and how global geopolitical tensions evolve. If expectations for a near-term rate cut continue to fade, gold could face further short-term weakness. However, its longer-term uptrend remains intact as investors this week are looking for a safe haven amid global uncertainty. Finally, let's look at the Australian dollar. The Aussie-US pair reached a 3-week high last week before easing back to around the 65.40 mark. The Australian dollar's movements have been closely linked to China's economic data, given the strong trade ties. Recent figures from China showed a drop in manufacturing activity with a slight improvement in the services sector. Meanwhile, political developments also played a key role, including the US announcement of the reduced tariffs on China's goods and progress in the trade discussions. On the domestic front, Australia's inflation data came in stronger than expected, which reduced the likelihood of near-term interest rate cuts by the Reserve Bank of Australia. Despite a modest rise in unemployment, the labour market remains relatively resilient. Technically, the currency pair is trading in a neutral zone with short-term support holding near the 65-cent mark. While the stronger US dollar continues to limit gains, any improvement in China's economic outlook could offer support for the Australian dollar in the weeks ahead. In summary, global markets remain highly sensitive to signals from the Federal Reserve and any shifts to global supply and demand dynamics. The dollar's strength, oil's weakness, and gold's volatility and the Australian dollar's fluctuations reflect a world that is still adjusting to evolving monetary policies and geopolitical realities. Trade safe, and I'll see you into the next week's update.